Hey, welcome to my YouTube channel. I am Xavier Smith, and today I'm going to teach you how to use options to make money in any type of market. So basically, what I'm going to do is just say a type of option, say what market it can be used in, explain how to use it, and then give you an example. And I'm going to do this for many different types of options. So you're going to have a lot of different option strategies to use. I'm going to explain how to use them, give you examples, and by the end of it, you should feel pretty confident on using options to make money in really any type of market. There should be timestamps saying like, hey, this is the iron condor and it's used for like bear or bullish. And then you can just skip around if you need to. Okay, so let's jump right into it. So the first strategy is bullish. It's called the long call diagonal spread. It can also be used as a put, and I'll get to that later. Basically, what you're going to do is buy a call with a strike price close to the current price. And this call is going to be out like a few months, like 3 months, 5 months, whatever, because you're bullish on the stock. And then you're going to sell a call higher than that for like a 1 month time period, like a shorter time period. And basically, what selling that call is going to do is the time is like the theta is going to decay the value of that option. And basically, you're just going to take the premium and pay off the call, like the long term call. So you're just buying a call for a little cheaper than it should be. And if that like call you sold does actually execute, well, then you made money from like the spread of buying the call and selling the call because it's a little higher. You made that spread. So you probably need options 2 trading for this to sell a call when you don't have the underlying shares, because technically you're buying a call, meaning that you'd like buy the stock. Yeah, whatever. You'd buy the stock, but then you have to sell it by selling the call. So you need options to trading, but really the risk is just in the spread, and there's not much risk there unless the stock actually goes down. So let's dive into an example. All right, so our example of the long call diagonal spread, of course, this is our bullish strategy. So for all of our things we go over, it's going to be a $50 current price. So we're buying a call that is at like strike price is at the current price, and this is going to be a long call. So it's going to be like 4 months out. And we're saying, okay, we're going to buy a $50 call. It's at $50, and that is $3. We're just assuming. This is all simplified. And then we're going to sell a call that is higher and for a shorter period of time. So we're going to sell this $55 call. And since it's further away, like the strike price is further, and since it's less time, we are going to get a lot less premium. So we're going to say we get $1, right? So our net, well, what we did is we paid $3 for this call and we got $1 back. So really our net cost for buying this call, because this is all we just wanted this call, is $2 instead of $3. So it's the price of the call minus the amount we actually got paid is $2, because that's really all we want. But if it actually does end above, like the stock ends above $55 in 1 month, then our profit would be, we're going to be buying at 50 and then we'd have to sell at 55. So it would be a $5 spread minus the amount of money like we had to put in, $3, so minus $3, and then plus the amount we were paid, so $1. So it would be $2 plus 1 would be $3 per share. And then the twin to this is actually bearish. It's called the long put diagonal spread. And I'm not going to give you an example for this one because it looks the same. It's basically you are going to buy a put close to the strike price, like a high value, and then you are going to sell a put way below the strike price. And basically what you're going to do is take like the time decay on the one that you sold, and it's going to expire worthless. And if it doesn't, you made money. It's going to expire worthless, and then you're just going to use that money you got from like selling the put to pay off the other put, and it just means you got the put at a cheaper price. So it's really the same thing, except you make money if it goes down. All right, the next strategy is the bull call spread, and this is a bullish strategy, which is just like the diagonal one, but instead of selling a call, like you're selling a call higher, but instead of that being like a shorter time frame, it's going to be the same time frame. So you're going to buy a call at the strike price or a little higher, and then sell a call higher than that for the same time period. And basically what's going to happen is the premium you get from selling the call is going to help pay off your call that you bought. And if the stock goes up, like if it rises past where you sold a call, your limitation, like your earnings are capped. But basically, if it rises above that, the money you earn is the spread between your strike prices minus the premium you had to pay to buy the call, and then plus the premium you got from selling the call. And then clearly, if the stock goes down in value, you lose your money. And if the stock goes above the call value, like the one you bought, you're probably going to make money. Sometimes you wouldn't, because it's like if you paid $2 for one down here and you got $1.20 up here, it's like you have to be 80 cents above your call value. But we'll get into that in the example. And then for our bull call spread, you can see I literally just crossed out long call and put bull call because they're basically the same exact thing. So you're going to buy this same call, right? But instead of selling the $55 call expiring in 1 month, you'd say 4 months, and you'd probably get paid, we're going to assume simplified $2, right? So instead, our net cost for this call would be like 3 minus 2 would be a $1 net cost for the $50 call. So that means our max loss is actually $1 per share now. Like it was $2 per share in the last one. Now it's $1 per share. And this is if the stock drops, that's when you could lose $1 per share, but that's it. And then here, if we look, if it does end above 55 in 1 month, your profit would be the spread, like $5. This is what you're hoping. You're hoping to get the spread. It's $5 minus you put in $3, and then you got $2 back, right? So you'd be getting $4 per share, which is a nice earnings. And if it ends anywhere between 50 and 55, you made money. Like technically between 53 and 55 would be perfect for you. Like that's exactly where you want it to be. But really, it could end anywhere above 53 and you'd be making good money. Anywhere just above 50, you'd be making a little less money just because of how it works out. But let's go to the next one. All right, again, just like the bull call spread, there is the opposite, and it is the bear put spread. So what you're going to do is you're going to buy a put that the strike price is near the current price or already in the money, and then you're going to sell a put lower for the same time frame. And basically, selling that put is just going to pay off the premium for the put that you bought. And what that's going to do is actually limit your losses if the stock does rise in value and your puts go to nothing. And then, but it also limits your gains if the stock does plummet in value. So it's really the same thing as the call strategy, but it's just with puts. So I'm not going to give you an example for that one. Let's keep moving. The next option strategy is called the calendar spread. This can be bearish, bullish, or neutral depending on where you do the option. So what you're going to do is buy an option with a strike price preferably close to the current price, and this could be a call or a put. And this will be out like a month, a few months, whatever. And then what you're going to do is keep selling that same option, but at a like shorter time frame. And what you're going to do is take advantage of the time decay, because over a week, like the time decay on a shorter option for like the same price, like it erodes the option faster. So basically, you're going to make money off the time decay on the smaller one, and then the bigger one's just like slowly going to decay. And that's like if you buy a put for like a little lower and then sell that same put, like you buy that put for like 3 months out and you sell that put every week, what you're going to do is you like sell the put, right? So you make money if the stock goes up, but if the stock like plummets, if you sell a put, you're in trouble, right? Because you have to buy that stock where the put is. But if you also bought that put, like bought that put for the future, you're kind of just saving yourself because you can sell it at the same price. And then it's the same thing with a call. So basically, it's like if it doesn't go your way, it goes the wrong way. Well, the call or the put that you bought is going to have you covered. And if it stays neutral or it stays around that strike price area, which is exactly what you want, you want it to stay around the strike price. You can just keep farming premium off of it. And over like a few weeks, your premium from like the week long ones will actually pay off like the longer one. And then you can just keep selling and you just keep getting premium. So basically, it's going to take like a little while to pay off the premium of the one you bought. but then you're kind of just secure and you can keep selling the same call or the same put every week until like the big one expires because you're covered by the big one. Okay, you don't need an example for that one. Let's go into the last two. The next strategy is a little confusing. It is for a neutral market and it is called the iron butterfly. It sounds super cool, right? So basically what you're going to do is you're going to sell a call and a put at the same strike price, probably the current price of the stock, and then you're going to buy a call and a put just like a little out of the money. So you're going to need an example for this one. It's good for neutral markets, and if it ends around the strike price that you sold the two at, you are going to make money because by selling a call at like $50 and then buying a call at 55 for the same like time frame, you're going to make money off of that because the premium from selling the $50 call is going to be more than what you had to pay for the 55. So you make money off that, and then same with the puts, right? And then if it goes too far either way, at least like the put down below or the call up high will kind of save you that money, right? So your max premium is going to be like the difference between the call and the put plus, wait, no, the call and the call, and then the put and the put. And then if it goes way far anyway, you're kind of protected by buying those calls. Okay, so let's get into examples. So our iron butterfly is our neutral strategy where the current price is $50 again, and we're going to sell a call and a put at the strike price. So we're going to sell a $50 call and sell a $50 put. Again, everything's simplified, so it works out really well, but actually, in reality, it wouldn't work out as well, like as whole numbers. So $50 call, we're going to say you get $2 for that. And since you're buying a $55 call, it doesn't even matter the time frame, right? We're just saying it's the same time for all of these. Since you're buying a call that's like further out of the money, it's going to be less, like worth less. So we're going to say that's $1. So our net here is we got $2 and we lost $1. So our net is plus $1 off of these calls. And then if we sell the $50 put and buy a 45 put, since this one's further out of the money, we'll only get like $1, 50% of it. So this is $2, $1, plus $2, minus $1. Our net's $1 again. So the profit, if it does end between like 45 and 55 here, well, yeah. Like if it ends between these two numbers, our profit is going to be the max of $2, right? Our premium, because it just ends neutral. It ends like same strike price. You want it to end just at like $50 and you get $2. If it ends anywhere out of there, you get a little less money. Like one of the calls will be worth a little more if you exit them. But really, you just want it to end right next to 50 again. And then if it's not between, then the max loss is like our $5 spread here. Since once it exits like 55 or 45, which is a $5 spread, then it would be like our current minus our strike price. Like that's $5 you lose, and then really it's covered after that because you bought the call and bought the put. It's covered out of 45 or 55, so if it keeps going, you're covered. You don't lose money. So that's $5 you would lose per share, but then minus the $2 premium you got off of these, because it can really only go one way. So it goes up $5 or goes down $5. You lose $5 max, but then you get $2 premium. So really you can only lose $3 a share. And if it stays neutral, you're going to get $2 a share. So let's go to the next one. And the final strategy I'm going to go over in this video is the iron condor. And this can be used in really any type of market, but is best in a slightly bearish or a neutral market. So what you're going to do is sell a call option just a little above the current price, like strike price a little above, and then buy a call option like above that. And basically what's that going to do is the one you sold, since it's closer to the strike price, you get more money off of it. So it like fully pays for the other one and you get a little bit of a spread. Like you get a little bit of money. And then you are going to sell a put option just a little bit below like the current price and then buy a put option after that. And again, you're going to make a little spread because the one you sold is closer to the strike price, so you're getting a little bit more money. And then basically the max amount of profit is like your spread here, like between the two, how much money you would make, like you had left over, and then how much money you had left over, put those together, that's your max profit. And basically the goal is to just have the stock end around the strike price and not breach either side of like where you bought a call or bought a put. You just don't want it to breach either side of that. And if it does breach either side, that means one of them is going to expire worthless. Like a lot's going to expire worthless. And basically, it's like how wide your spread is minus like the total premium you got paid. So let's get into an example because it's going to explain it a lot better than I can here. Finally, we're going to do the iron condor, which can be used in slightly bearish or bullish like markets, but really it's best for neutral markets. So again, our current price is $50. And just like the iron butterfly, we're going to be selling calls and selling puts and then buying calls and buying puts. But instead of like selling the call and the put at the same value, like the strike price is the current price, we're going to sell the call a little out of the money and sell the put a little out of the money. And what that does is in the end, actually like we have a wider range of values it can be for us to get our maximum profit. So with that aside, let's get into it. So you're going to sell a $52 call. It would be like 52.5, but we're going to say 52. Buy $55 call. Of course, $55 call is going to be worth less. So really you make a net $1 profit. We're just going with that. And then here with the puts, it's the same thing. Sell 48, buy 45. You get like net $1. So if it ends within the $4 spread, so instead, like on the iron butterfly, it really had to end at 50 for you to get your $2. If it ends anywhere else, you might have lost a little bit of money somewhere, or yeah, you might have just lost a little bit of money somewhere. But here, if it ends within these $4, you are making your max profit, your plus $2, because that means you don't have to buy the stock and you don't have to sell the stock, right? If it ends between these, neither of these are executed, and it's just perfect. So you'd make $2 max if it ends anywhere between 48 and 52, but then your max loss is if it's outside of this spread, really is $3, because it's like you're protected $5 on each side of like the $50. You're protected $5, but you got your $2 premium. So again, it's $3 per share. So you're risking $3 per share, but you're getting max $2 premium. So this is again really good for neutral. Anything that's like very bearish or very bullish, do not do the iron butterfly or the iron condor. You're gonna lose money. Just don't do it. This is for neutral. Okay, well, let's get to it. All right, if that video was helpful, please leave a like and subscribe for more financial tips. And I really enjoy making these videos, so let me know if you guys like them. Let me know if you have any suggestions or if you guys want me to keep talking about options, because I love learning about them and I love talking about them. So I hope to see you guys next time, and thanks for watching.